Good day, economic learners. Today's video covers the recent trend in the banking industry. All of the information contained in this particular video, or a great deal of it, stems from an article which was in the October 18th version of the Wall Street Journal, and it was entitled Banking Industry Faces Squeezing Profits. So let's take a quick look at the banking business and talk about the particular services that banks provide to their customers. The first two are highly similar. Banks originate and hold loans, mortgages, commercial real estate, office buildings, apartment buildings, maybe even manufacturing firms often borrow money from a bank, don't pay for the entire facility up front. And this has actually been one particular area of strength for banks. Commercial lending has been up because the economy has actually tracked a bit better over the past 18 months or so. Residential real estate loans, the second type of services offered by banks, this is one of the key sectors of weakness in the banking industry. It's weak for two reasons. Number one is newer regulations are making it more difficult for people to qualify for loans. And more importantly, at the same time, interest rates have increased significantly from their lows. If we go back, it's currently the middle of October of 2013. If we go back to the summertime, people with good credit could easily qualify for a 30-year fixed mortgage at roughly 3.5% interest for 30 years, and 15-year mortgages were offered at 2.5% interest. Mortgage rates on these particular loan items, these lending instruments, have increased over a full percentage point, which means it makes it more costly for borrowers to pay back the loan. The other two services offered by banking industries, trading, and then of course traditional bond banking services. Let's talk about trading first. Banks trade bonds, currencies, and commodities. We're going to look at who are the big players in the banking industry on a further slide. But if you think about banks as lending institutions primarily, but also as financial institutions, so they trade on behalf of their own clients and they trade on their own behalf as well. If we go back about 3 years or just a bit further, because of the volatility in the financial markets, there was a great deal of trading taking place, especially with bonds and currencies. Banks make money every time a trade is executed because they charge a service fee to execute those trades. Because there's fewer trades taking place with some of the volatility settling down, banks have lost revenue from this particular service. Likewise, banks hold a large amount of their assets in bonds. Now, this is not a lecture on bonds, but you should understand that there's an inverse relationship between interest rates and the value of existing bonds. It works primarily in this way. If we hold bonds today and interest rates rise, the bonds we are holding are worth less than they were yesterday. So when the interest rates are rising like they have been in the current economic environment, the value of bonds that banks hold currently declines. So the rising interest rates has also caused banks, when you look at their portfolio of bond asset allocation. The final piece to the banking business is the part that you're all mostly familiar with, is that banks charge customers like you and I for services using our ATM machine and our checking account and such. And these actually have picked up a bit, but these aren't the bread and butter of the banking industry, and therefore haven't really helped with the slump in the other services. So who is in the banking industry? Well, the banking industry is run primarily by the large banks, and here are some of the big players: JP Morgan Chase, Citigroup, Wells Fargo, and Bank of America. JP Morgan Chase has a large brokerage house, so they make a good deal of their income trading those securities, those bonds we were referring to on the previous slide. They also trade obviously commodities and stocks and currencies, but their trading window has narrowed because there's fewer trades with less volatility. Wells Fargo has significant exposure to the mortgage industry, as they are the nation's largest lender. Now, the smaller banks are ones you probably haven't heard of unless you're either a banking industry expert or you're interested in financial markets and you have decided to either buy or sell stock in these regional banks. But different sectors of the country, the Midwest, the Northeast, the Southwest, the Far West, have regional banks which typically operate to serve the needs of those particular regions. These smaller banks also have significant exposure to residential housing mortgages, which means they have lost significant amounts of revenue or income because of the slowdown in mortgage origination and mortgage services. Let's examine current trends in the banking industry with one of our primary economic tools, and that is the supply and demand graphs or models, which we can use to analyze markets. In terms of our supply and demand analysis of the banking market or the banking industry, it's a pretty straightforward picture. Which non-price determinant of either supply or demand has been affected lately? Well, there's been a significant decrease in the number of buyers, a non-price determinant of demand. Fewer mortgage originations and services, fewer trades made by banks, so fewer number of buyers in those particular services, which leads to a decrease in demand. The result of this decrease in demand is price down, quantity down. Now in this case, price represents revenue to the firm. Obviously, quantity is the quantity of services offered by the banking industry. How does this affect the labor market in the financial services industry? The labor market fluctuates significantly with business cycles in the financial services industry. Banks' largest cost of production is their labor. Obviously, a variable input, something we touched on in great deal in microeconomics. So variable resources, variable inputs can be adjusted significantly based on the price in the market. So a decrease in bank revenues forces banks to look for ways to cut costs, and the easiest, quickest, and most efficient way to cut costs is to just simply lay off people, lay off workers. So again, a decrease in the number of buyers is the non-price determinant of demand, which decreases the demand. The demand curve will shift from D to D1 as on the graph. And what happens is that people get laid off. And if we look at the article, they have the exact numbers of people, large numbers of people being laid off, and the thousands of people by the larger banks and hundreds, if not small thousands of people at the smaller regional banks. So price and quantity here, price represents wages paid out to employees. So this particular graph is an examination of a labor market. So you can think of the vertical axis as the wages collected by employees at banks. Obviously, price down and quantity, number of people working, the laborers, the employees, also decreases.